Hello, happy Thursday. Today is July 9th, 2026. My name is Ward Keever, founder, president, and CEO of Covenant Wealth Strategies. I'm joined today by Michelle Fisher, who is our Director of Strategic Communications at Covenant Wealth Strategies. And we are honored, very honored today to have our good friend and returning guest speaker, Dr. Jeffrey Roach, who is the Chief Economist at LPL. You may recall that Jeff was with us back in January. So he has come back to join us, which usually means that his comments and forecasts and projections were spot on. If our speaker comes back, he wants to come back to tell us how he was right about everything he said in his previous presentation. But Jeff is the Senior Vice President, Chief Economist at LPL, serves as a voting member of the Strategic and Tactical Asset Allocation Committee, where his ability to relate economic conditions to financial market outcomes is highly valued. Prior to his role at LPL, Jeff was a senior economist with Visa, where he focused on macroeconomic forecasting for both internal stakeholders and external global clients. Jeff started his career as a trading floor economist on Bank of America's corporate trading desk, and was also a portfolio manager for not just any old mutual fund, but a 5-star rated mutual fund. There are many other things that I could tell you, but I will say that Jeff earned both a PhD and an MA in economics from Clemson University, as well as a BS in mathematics from Bob Jones University, and received a visiting research appointment at Harvard University. So those are some of his illustrious credentials. I will tell you that I appreciate Jeff personally. He had the opportunity to visit with us at our home in Ocean City, New Jersey, a few months back, and was successful in picking up a few 5-gallon drums, maybe, of Johnson's popcorn on the boardwalk, and was just telling us about the efforts to smuggle that stuff past TSA and the boarding people at the airlines who all they didn't want to know whether or not it was an extra carry-on. They wanted to know if he was going to be sharing his Johnson's popcorn. But he successfully got at least the majority of it home, and his wife and children enjoyed it as well. So we have a lot of fun. Consider Jeff a personal friend. I'm thankful for his willingness to come and speak to us today and share with us our mid-year outlook. One other thing I would just comment is that locally here, we are experiencing a severe thunderstorm with flash flood warnings and thunder. So we have already prayed and are hoping that this entire presentation comes off with no problems. But if for any reason we are suddenly interrupted, you will know what happened. So we're going to do our best to not have that experience. So Michelle and I will likely go on mute and dim our video so that, Jeff, you'll have the full screen and your slides. And we very much look forward to your comments. And if you have questions throughout the presentation, please email those to Michelle with 2 L's, Michelle with 2 L's at covenantwealthstrategies.com. And we will accumulate those questions throughout the presentation, and we'll do a Q&A with Jeff at the end of his presentation. Did I miss anything? Without further ado, Jeff, please take it away.
Yeah, great. Well, before you go on mute, though, I do want to share my screen, and I love to get some confirmation that you actually see it. So does that show up here?
We've got it. I thought you were going to show your screen with some pictures of popcorn tins, but yes, we've got your 2026 mid-year outlook. So thank you.
Excellent, excellent, good. Well, I do enjoy the Q&A, so please, there is no such thing as a dumb question. So please feel free to engage. I'm going to give you a couple of hot takes. There are a lot of items up for discussion. And I guarantee you, this is one thing I can guarantee. I can guarantee you that I'm not going to touch on all of the hot topics. There's 1,000 of them. I'm just going to touch on some of the things that I've been thinking through and our team at LPL has been thinking through. And so that's what we'll do. So before we hit to the 2026 mid-year, we did do an annual outlook, and you're exactly right, Ward. I did present early this year talking about this. You were constructive on the markets. We knew there was going to be some volatility. We knew there was going to be some slowing, particularly in hirings and growth, but we're not in recession. That was one of the key takeaways from our January talk that we did together. Not in recession, not heading to recession. Fed would probably be able to ease the latter half of the year. That's new because we did not forecast an attack onto the Iranian countries. So with that, there are a couple things that are different and things that we had to adjust with our mid-year, but certainly there are some things that are staying the same. So I think one of the things that's right off the bat very interesting to think about, probably highlighted this in our presentation back in January, is midterm years often are good years for markets for a number of reasons, even for those in the second term or the first term. Those midterm elections, a lot of energy, a lot of push toward being pro-business and that kind of thing. We do have a couple of seats up on the House side, as well as I show here, 35 seats are up in the Senate. So there's a chance that Democrats could flip the House, probably not the Senate. In fact, it's most likely they cannot flip the Senate. So that's going to be interesting if that indeed does happen. A little bit more gridlock with House being controlled with Democrat Senate. So that's just kind of setting the stage for a policy-driven type of market. In fact, that was what our annual outlook was titled when we published it in, I guess, early December, and then I presented in January, a policy-driven type of scenario. So want to talk about a couple things. So, here we are, 2026. We were not in the camp that tariffs were going to push the economy in a recession or necessarily be a long-term drag on growth. It's more of a short-term hit. The couple of things that we know about tariffs are taxes, but what we often see is currency adjustments sometimes soften the hit to tariffs, meaning home country like the U.S. tariff somebody coming, say, from the Brazilian real-based goods, instead of the consumer feeling the full brunt of the tariff, if the home countries or exporting countries' currency weakens, in essence, that softens the blow. And I think that's exactly what we've seen. So we had interesting movements in terms of just trade, and that actually was part of the reason why we saw a ton of volatility in just how global trade was adjusting, not only latter half of 2025, but still in the first part of 2026. Now, one thing that's important to remember is outside of this tariff concept, it's important to start learning a new phrase, and that is what we call resource nationalization. And it's been around, particularly we think of it when we think of the Congo, some of these African countries. It's basically where governments want to control their own natural resources as much as they can to secure the economic benefits that they get and leverage geopolitically. And that's something that now is broader, not just, say, in emerging markets that don't have a lot of leverage and so they use their natural resources like that. We're starting to see that in several countries, including our own. We want to bring manufacturing home. We certainly want to take advantage of all of the domestic oil that we have, Permian Basin, for example. So think of that going to be a major factor the latter half of this year, as well as going in the next several years, particularly Latin America, a lot of these commodity exposed economies. So this is just a number of export bans, basically making the case that even in the last couple of years, we've just seen countries saying, you know what, we're going to try to use this as leverage. In fact, we can't blame them. That's what the U.S. has been doing for decades, since the French prime minister back in the 60s talked about the exorbitant privilege the U.S. had because of the U.S. dollar. The dollar was definitely something that we weaponized because we could control and influence a lot of global trade because so much of global trade was traded in dollars. All right, so that's a trade story. We can talk more about that in Q&A, and happy to do that. The big story, obviously, this year it has kind of ratcheted up even from where it was last year, and that's the Mag 7. This is just showing just a few of those. You got Oracle, Alphabet, Amazon, Meta, and Microsoft. So 5 of the Mag 7. And what we're highlighting here is the fact that there is still a lot more in the pipeline for these 5 companies in particular to allocate toward what we call CapEx, capital expenditures. And that's just, that's equipment, that's structures, warehousing, that's software, that's intellectual property, all the things that businesses use to create what they're doing and develop more business. And so CapEx is definitely a driver on growth, and it's going to continue even into 2027. That's one of the reasons why we think, hey, maybe things are running hot. We're not in a bubble yet because it seems like there's still a lot more cash that these hyperscalers, so think cloud computing, think those technology companies as referenced right here. Meta, of course, is Facebook. Alphabet, think Google. So make sure we're all on the same page here. And that's those are the names here. So we still think, given the forecast going into this year and next year, there's still a little bit more runway. Meaning we think there's choppiness in the tech space. We've kind of pulled back a little bit of exposure. We've kind of taken those gains, taken it to the house, not putting a lot more overexposed to this category. But we do think, despite maybe some choppiness here, they still plan on expanding. But they need to monetize that after the expansion. All right, so how does that roll into rates and growth? One of the things we're kind of big picture here, and that is this. We've had recession. This is what the gray bars are here. You see all these gray bars, shaded areas here. Late or early 90s recession. Here's your 2001 recession. Here's your great financial crisis, the COVID recession. Obviously, this GFC, we call it, the great financial crisis, was one of the longest recessions we've seen. And what's interesting and what we're seeing right now is an unusual experience where we see rates on treasuries, that's the blue line, treasuries, are higher than where the Fed has put their upper bound of their Fed funds rate. And that's a little bit unusual. We've seen it now post GFC when rates were really, really low. But we've seen it kind of, in the early 2000s. And what this tells us is that given the fact that the economy is still growing, unemployment's not high at all, and inflation is still sticking around a lot longer than we thought it would be, the Fed's most likely not going to be able to cut the latter half of this year like we thought back in January. Meaning Fed funds rate's going to stay a little higher, which is kind of the benchmark for how banks interact with how they borrow from each other, how they borrow from the Fed, and all that kind of filters through into the retail rates that we as consumers know about, like mortgages, auto loans, other rates that the consumer hits. So we do think that we're in a position where growth is steady, economic growth is steady enough where we're seeing this reversal from a Fed funds rate being above the 2-year. So now that has switched over. So expect the Fed to stand pat. We don't think, unlike a lot of the market participants right now, a lot of big talking heads talk about the risk of Kevin Warsh, the new Fed chair, hiking rates. We actually think that they'll hold rather than hike. All right, so that's kind of setting the stage. Let's talk about the economy. We're going to talk about equities, bonds, commodities, and kind of alts. And then we'll be done. We'll do some Q&A. So that's kind of the roadmap for today. Economies, equities, bonds, alts, commodities. All right. So where are we? Okay. So this is just growth. It's a little bit choppy here, but think of these the diamonds are what your normal mainstream media reports on growth, meaning we're above zero. We were growing really strong in 2025. We slowed down the back end of 2025 going into this year. We do think that we'll have some stable growth, a lot of it driven by the services sector of the economy. We don't think that there's going to be a major drag on trade. So think about March 2025. Whenever you get a chart, you say, okay, what are the things that stick out and why? Well, net exports really detracted on growth in Q1. So March 2025 is the end of Q1 because the businesses knew, hey, tariffs are going to hit in April. And so let's start importing all this required items for business. Let's import a lot now. Hence, when we import, net exports is a negative number because we're importing more than we export. And that import kind of subtracts from your headline growth numbers because we didn't produce imports domestically, right? GDP is gross domestic product, means what are we producing in this country? Stuff we import, we got a ton into the economy. We didn't make it, so let's subtract that from the number. Hence, that's where you have kind of this weird payback in Q1 and Q2 of last year. So that's kind of setting history for going forward this year. No recession. Again, in the near term, we do think a lot of the economy is particularly buoyed by two things. One is you have some really well-heeled millennials. You have the spending of the baby boomers. You have a number of these cohorts that are benefiting from what we call the wealth effect. That just means, hey, when the market's up, the market's been up for several years now. When the market's up, people look at their balances and they say, oh, my 401k is higher. My retirement accounts are higher. Okay, I'm going to do okay. Let's take the vacation. Let's upgrade the car. Let's help out the family member and buy XYZ. So consumer spending still looks pretty decent because debt pressures relative to disposable incomes are looking pretty good. And from the business side, you have a lot of capital expenditure still. People are buying the equipment, buying the software. A lot of industries are still ramping up for the AI investment, the artificial intelligence investments. So we think we'll avoid recession. Key takeaway. So what does that mean for inflation? That means if you have still a lot of people willing to spend, there's still a lot of demand for travel. It's interesting. Some of the data I look at might seem weird, but one of the data points I look at is TSA throughputs. I like to watch, okay, are people traveling? Are they still buying airline tickets and going to visiting friends and family and traveling to vacations? The answer is absolutely. So there's still this demand on the consumer side that's keeping prices elevated. But we do think, by the latter half of this year, we'll get to the number where we thought we could have gotten to by now, probably. Here we are, early July. Inflation easing, decelerating is kind of pushed out a little bit later into the future, particularly because of these geopolitical shocks. That's one item here, as well as a still well capitalized consumer. All right, so what are we looking at in order to say, okay, when do we need to change our baseline? Right? When does recession risks start showing? And the answer to that is particularly in the labor market, when individuals can't find a job that want to work, or people quit looking because they get what we call discouraged. Discouraged workers are those that are not counted in the official unemployment rate, but they're unemployed and they stopped looking for work. Remember, it's a little technical here, but it's important to know. The unemployment rate is the number of people unemployed that are looking, that are actively looking. Meaning, if you're unemployed and not looking, you're not counted in the unemployment rate. So that's something to just understand, and that's why it's important to look at some of the broader measures a little bit more under the hood, as it were. So we're certainly tracking it at LPL Research, tracking some of the labor metrics that we get, throughout the month, in order to help us provide leading indicators for when we say, okay, maybe we do need to reevaluate the appetite for risk in the markets. All right, so let's talk stocks. So that's the macro backdrop. Stocks is this. We've seen pretty decent gain in earnings growth. That's what's been driving a lot of the market. Now, granted, some of this market's been driven by just a few names, so it's really, really helpful to say, okay, outside of NVIDIA, and for example, how's Walmart? How's financials? How are the big banks doing? How's healthcare? How are some of those sectors that are outside of the unusual movements that we've seen in tech? And we've seen kind of rare and steady increases in earnings estimates, meaning we are constructive on the markets. Yes, some volatility, but we do think markets will be up the latter half of this year, just like we said in January, and so far so good. Certainly been a little bit of choppy here and there, particularly driven by headlines. And here's a note of caution: don't react to headlines. My first job was at the Bank of America trading floor out of graduate school, and it's always good to remember, we are not traders; we're investors. And that's a very different thing, because it's all about time horizons and not trying to, capitalize on a headline for that matter. All right, so valuations here, we are definitely running hot on a valuation basis. If it's just PEs, price to earnings, but we want to make sure that this perhaps they're not at extreme valuations. We think they're fair to maybe a little bit higher. So it's worth still having some exposure, even though from a valuation perspective, things look running pretty hot. There's still we think there's still more to go. Is the bottom line. Now, we say, well, things could get choppy. One of the reasons why we say things could get choppy is we base it on this is basically a measure of volatility in the tech sector, and we just think, okay, this has had quite as we say, a crowded trade, and so we want to be careful and not overexposed to the tech sector and look for other opportunities. Like I said, industrials, healthcare, financials. Those are some other sectors that still look good, and at the same time don't feel like what we call as a crowded trade. All right, so here we are, year end, 7,600 to 7,700. That's the S&P 500. Now, granted, that's just one benchmark. Think of it, the markets are much broader than just that. We like to talk about the S&P 500 because that's what a lot of clients end up, relating to. So a little bit higher. You can see our 27 forecast a little bit up from even our 2026 forecast. Okay, let's talk bonds. Again, it's 26 after the hour. Don't want to bore you with slides and death by PowerPoint. So definitely have some Q&A in just a second here. One of the reasons why things have been a little bit choppy, in addition to some of the things I mentioned earlier about hyperscalers and things of that nature, is this transition from Jerome Powell, who's the previous chair of the Federal Open Market Committee, to Kevin Warsh, the current and newly installed chair as of June, I believe, right? Well, June 17th was his first meeting he emceed, and I think he was confirmed by the Senate a few months before that, nominated, of course, last year by the president. So we went from expectations early part of this year. Most people were expecting a cut. This is what this chart is telling us: expectations for a cut, and then this switch driven particularly by the events end of February, the attack on Iran, and then kind of what we've seen going forward in inflation pressures since then. Want to highlight this. I might have talked about this in January, but I won't blame you if you forgot. The Fed, I believe, is able to keep its independence and will remain independent as much as it always has been. Granted, there's always a role of political jockeying. Part of that's because the rate setting committee is partially made up of individuals that are nominated by the president, confirmed by the Senate, and then appointed to the board. One of the reasons why I think it's independent is because by definition and by the creation of the bylaws, these board of governors serve a very, very long term. So we're talking double digits, so they can sometimes quit early, but we're talking 12, 14 years, meaning that they're going to last longer than just one or two administrations, or at least one administration. But the point I like to highlight is the other half of the rate setting committee is made up of a rotating membership of the presidents of the 12 district banks. So we have all the way from San Francisco, all the way through Denver, Kansas City, Dallas, Atlanta, Boston, Richmond, Chicago, Philadelphia, a number of 12 districts. Those presidents are actually appointed by a board of directors that are made up of private citizens. So, for example, we might have at a certain cycle the president of the Richmond branch of the Fed voting as a voting member of the Federal Open Market Committee. He's actually put on there by a client of LPL Financials. We have a banking representative who's on the board of directors in that Richmond system. And so those private individuals select a president, they vote, meaning this is not all about the president. It is it's a very American representative form of central banking. And so that's why a little bit detailed, but very, very important to understand, because what it does, it should give you a little bit of comfort knowing that even in our central banking, we have very strong American principles in the checks and balances of the central banking structure. All right, so we can talk more about that during Q&As too as well. So here's one of the things that has been interesting. This is why we say carry on and keep clipping coupons. We actually are seeing a lot of interest now, not only in the equity markets with hyperscalers, but also in the debt market, meaning you see a lot of these tech companies issuing debt based on their interest in growing out, their artificial intelligence. And so there's a real big pipeline of issuance. And so that's got to, you think about, how do you attract, if you keep on issuing debt, how do you attract investors? Well, pay them a little bit more, meaning the yield will rise a little bit. So we do think that there might be some upside pressure on yields. But that might be good depending on where you are in the allocation phase. So think of that as a part of the calculus in your own allocations. All right, alt investments, commodity and currencies, and then I'll pass it back to you, Ward. Alts. So I think one of the things right off the bat, I want to say, oil is a big story here, clearly because of the Strait of Hormuz. One of the things that's a little bit unknown is where the supply story comes. Now, this is from the EIA, Energy Information Agency, not to be confused with the IEA, which is the Paris-based international organization that tracks a lot of this stuff. But it's all about domestic supply. So this chart, let me just explain this. This is the price of Brent, not West Texas Intermediate, WTI, but this is Brent because this is more of a global traded commodity, slightly different. So here's your prices of Brent inverted on supply. This is, the barrels right here. days of supply, so days relative to how many barrels you consume. The reason why it's inverted is because as supply goes up, more supply come to the market, that'll push prices down, right? And vice versa. So there's this inverse relationship. This is all about domestic supply. Remember, the U.S. tapped into strategic petroleum reserves in order to ease some of the pressure on oil prices. Now we're seeing a lot of rig counts increase, meaning firms want to tap into the domestic supply to offset the pressure coming out of Strait of Hormuz. Key takeaway here is, not to overcomplicate, key takeaway here is this. The fact that we had this issue in the Middle East and we're seeing oil trade in the low 70s, this is West Texas because that's the domestic side, means that this conflict, yes, will impact some of the true macro variables, but it's not going to derail the economy. And I think that's a kind of a key takeaway here. All right, so in addition to oil, that's a big story. I do want to talk a little bit about the dollar, and then I'm done. So there's always been, every 5 to 7 years, there's always been this massive PR blitz from particularly China, Russia, saying, hey, we want to dethrone the dollar. We want to have an alternative currency. How can we do that? I think the key point here is whenever you see a spike in volatility like we did early this year, if the dollar ends up rallying and strengthening, that means it's still considered a safe haven for global investors. And that's exactly what we've seen. We had this slight uptick. Now, yeah, we're not as high as we were in 2023, but we do think that there is this uptrend and it will hold. Number one, because the dollar is still the safe haven currency. We've seen it since February, and we're starting to see Fed communications about, hey, remember what I said, we're holding, we're not cutting, we're going to hold rates steady. The rest of the world is talking about cutting, like European Central Bank, Bank of England, a number of other major central banks. That interest rate differential, meaning our rates higher than other major countries' rates, that's going to strengthen the dollar because rates, in essence, are a little bit higher here in the U.S. So I'm going to stop with that, and I'll definitely want to get some of your comments or questions, but there's a lot to consider. I just wanted to remind folks here, this is ongoing. Being in the markets is a very humbling experience because there's always something new that's hitting, and you have to always be rethinking your baseline forecasts. What could cause us to derail, and being mindful of those risks and managing to those risks. So back to you, Ward.
Jeff, thank you so much for your presentation. I think it was Hank Paulson, Treasury Secretary in 2008, who is famously quoted as saying, we must be pragmatic enough to change our perspective when facts and circumstances warrant. And certainly 2008 was a dynamic environment. Thank you so much for your presentation. A few questions that we have that have come in. And again, if you have additional questions, Michelle, with 2 L's, Michelle at covenantwealthstrategies.com. So a few questions that have come in. We were talking about the hyperscalers early in your presentation. We were talking about CapEx. Where do you think we are in that process? I've heard others say that we're quote unquote early innings. So how long do you think that this could go on? Because it certainly seems to be a huge stimulant for the economy.
Yeah. So I would definitely say that we still have more to go here because we're in the beginning phases of the build out. And then on top of that, you have the next phase to say, well, are we getting any bang for our buck? We're talking about the monetization, but that might not be until 2028, maybe late 2027. So we're very much still in this early build out phase. Yes, it's captured a lot of investment, a lot of dollars, but the jury is still out because not many well, I wouldn't say not many, but a fair amount of industries are at the very beginning of just even utilizing the benefit of this build out. So it's still kind of in beta mode. We talk about beta being kind of beta testing. You have an idea, let's test it out, and then we'll roll it out to the masses. We're still very much in the beta testing. Now, in theory, we do think that this could be like a late 90s where you saw businesses moving to the PC, right? We're not printing out reams of paper. We're transmitting electronically, and that took time. You think about that. I mean, it was several years and years of build out. Certainly added to productivity. I do think that even though we're still early innings, we're in beta testing. I do think that there's some early signs that this does help us become more efficient. Interestingly enough, I will say, caveat, I do think it's very dangerous and erroneous, quite frankly, to say that AI agents and things are going to replace humans, and the demand for workers and things. It's really just gonna augment, generally speaking. Now, yes, when the telephone was invented, if you were a telegraph operator and you weren't willing or able to kind of pivot, yeah, you lost your job. We didn't telegraph, but still, a lot of those concepts translated into a new technology. So, don't think of AI coming for your job as as a substitute. It's a complement, but it will make us more productive. Early signs do suggest that will be the case.
I've heard it said that AI will not replace you, but AI will replace you if you don't know how to use AI. And so it's
Right.
similar also in terms of the internet or the World Wide Web. There were all these grandiose things about a 4-day work week or a 3-day work week because the internet was going to, we wouldn't have as much work to do or anything else. And I think true to form, we learn to use new technologies to enhance our productivity. And if anything, the expectation, the bar moves higher, not lower. Still waiting for that 4-day work week or 3-day work week. So,
Well, it's all about innovation. I think you're exactly right, Ward. Not to belabor this one, but I think this is a great conversation. Thinking about training the next generation, right? We have a lot of. You think about the Gen Zers, that are thinking and coming into this brave new world. We really ought to focus on, hey, be creative, be innovative, think outside the box, because technological innovation will perhaps allow us to do things that we didn't think possible. So back to your point, it's not as if we went from a 5-day week to a 3-day week. We just went from a 5-day week doing some cool stuff to now it's a 5-day week where we're doing a lot of cool stuff.
Yeah. I was working on a project, or I am working on a project, and we had to pull a permit for something. And the individual that was responsible for pulling the permit had to go back to get through some township history or whatever else. And I'm not sure if it was on microfiche or what it was on, but it was from 1987, and it was handwritten notes about a special zoning exception or this sort of a thing.
Yeah, wow.
And the individual, I'll call him a young man, but I think he might be 40 or close to it. And his comment was, I guess they didn't have email back then. And I'm laughing because I'm thinking I was around when the world didn't have email. And I spend how many hours a day right now doing email? I'm thinking what was my quality of life before there was email? But yes, technology, innovations, and that sort of thing. And even just, again, not to belabor the point, but on this idea of CapEx, hyperscalers, AI, I mean, it's really touching everything. We're talking about chips and chip manufacturers, but these chips have to go in something that might be a data center. Data centers require copper. We need electricians to run to wire all of this stuff. We need concrete. We need all these different things. So it's just so much more. People talk about AI, and you mentioned a point a moment ago. A lot of people have heard about AI. There are varying percentages out there, but let's say less than 50% of people have actually ever used AI on purpose. A lot of us have unknowingly used AI, and kind of how you define that. But what percentage of people do you think are actually paying for AI? And that comes back to your point, Jeff, about the monetization. So these hyperscalers were spending tens of billions of dollars on chips and data centers and all this other stuff. But how do we monetize it? When do we monetize it? But maybe you could speak also to just how it is systemic throughout the entire system. It's not just chips, it's all these other things.
Yeah, yeah, and it's in the services sector, it's in the goods manufacturing sector. So back to utilization rates, we're in some industries it's amazingly low utilization rate. So there's still I think in several sectors, even in healthcare, surprisingly, because you'd think, okay, there's so many ways in which to read X-ray results and read the, what does it mean here for efficiencies. We're seeing pretty low utilization. Now, we do know that hospitals, for example, and other industries are planning to spend more of their budget on licensure, but they're still trying to figure out how to use it, how to implement, I should say, right?
Yeah.
How to have policies implementation. That's why I think we're very in the early stages of utilizing this.
Before we move on to the next question, could I just ask you to chase a rabbit a little bit further and talk to us about the future of technology and the idea of quantum computing? Because when you talk about application, healthcare, and specifically pharmaceuticals, biotech, they're talking about molecular modeling and things that would take years that now through AI and then potentially further accelerated by quantum computing could literally be done in weeks. And so as they're developing medicines and these sorts of things, would you speak to that a little bit?
Yeah, well, that's interesting to say that. I have been reading on this, some interesting books I can share with you later on this. And, a lot of this, Silicon Valley money is driven by folks that want to live longer. We hear that. We even hear that from Europe too, and Putin and a number of these guys are like we. So what's interesting is I think in a good sense it is hitting the research and development component. So you want to test a drug, how it fights cancer. You can test it a lot faster. So it's possible that drugs can come to the market sooner rather than later, and they're really well tested, even tested better than they were in the past. That's always the risk, right? Hey, how come this thing came to market so fast? That makes me nervous. It might be actually better tested and shorter testing period. So that's certainly going to be very interesting, because what it does is I think it may actually accentuate what we're already modeling out, and that is a shrinking labor force, right? People are living longer, which means there's going to be a greater percentage of people, 67 and a half and above, who are not necessarily actively in the labor force like they were before. And so that dynamic is very, very interesting, has a lot of ramifications for growth, for housing, for demand for healthcare services, aging in place, all that kind of stuff. So interesting focus right now, and it really is a main driver of the investment, the application for medical testing.
Yeah. Several years ago, I read a book entitled The Upside of Aging. It was fascinating. It was a collection of essays. Two of the key takeaways. Number one is that prior to the 21st century, the average life expectancy was about 40. And in the last 125 years, we've more than doubled life expectancy. And there was a graph or a chart that went through like centuries, and here's your life expectancy 40 40 40 40 40, and then all of a sudden it goes like this, and basically we doubled it since 1900. But the other takeaway, one of the essays was theorizing that the first person to live to age 150, they're saying, has almost certainly already been born. And the socioeconomic implications and other implications that are just fascinating. Let me segue to next question, which was having to do with, you talked about at the beginning of this year, we were forecasting Fed rate cuts. And now we're basically saying probably not this year. I think there was some question about maybe in 2027, but there's also some conversation about maybe a rate hike. And your graph, I think, kind of showed that. So where is LPL? Where is Jeff Roach on? Do we just kind of muddle through without a hike and let this exogenous shock of the Iran conflict kind of work its way through the system, or do we think we're actually going to see one or two or three hikes in this in this cycle?
Yeah, so I don't think we'll see a hike. I think there's a lot of jawboning about it because of the near-term pressure on inflation, particularly due to high energy prices and the risk that this kind of filters through and seeps into other industries. I think what most likely will happen, particularly when you think about midterm elections, that's why I started with that. You have a lot of pressure for the president to say, we got to get a solution with Iran. We got to get a solution with the Strait of Hormuz before the midterms, because it's to my advantage to get a solution before midterms. And we might actually see some improvement in inflation numbers by this year versus right now. I mean, worst case scenario could be 2027. Hence, that's one of the reasons why I think once we get a resolution on the geopolitical side, inflation expectations will come down. Actual inflation, particularly on energy impacted items, will come down. Hence, the Fed doesn't have to deal with it by hiking. They can stand pat.
Then we saw that over the course of maybe the last couple of weeks with the quote unquote deal or memorandum of understanding, whatever. And we saw oil prices coming down. We saw gas prices at the pump coming down. We've seen announcements over the last week by major retailers such as Walmart with prices being cut, not by a little bit, but by pretty significantly. So those would certainly help dampen inflationary pressures. We'll see now that that the deal's off. We'll see how energy prices do on that. Let me shift gears to earnings. You had put up a chart and we're referencing 2027 earnings forecast, I think of $350. Others, we've seen forecasts of 400, 420 in 2027. Are they overly optimistic? Are we just conservative? Or what's the difference between Jeff Roach's S&P earnings of 350 and somebody else's estimates of 400 to 420?
Yeah, we're basically just saying, hey, we can't use the run rate of the last 6 months and extrapolate that forward. We're basically saying, hey, look, this is unusual. We're not going to see in percentage terms a run up like we did with NVIDIA, and then the volatility, even with the IPO of SpaceX. We're basically saying, let's take a longer look back here period and be a little bit more conservative. That's kind of the key takeaway, where we're saying, hey, we're optimistic and constructive about the markets next year, but we're going to take a little bit more of a cautious view.
Mm-hmm. Okay. Jeff, I think we're going to leave the questions there. Actually, I'm going to just one other thing. Thank you for your explanation about the Federal Reserve and how voting members are made up. So this is a question from me. Why do you think all this buzz about Fed independence? Like, based on your explanation, it seems as though this is a non-issue or almost a made-up issue, because it seems as though the Fed is inherently independent based on, as you said, community members that appoint a quote-unquote bank president, like the Richmond Fed Bank president. It's got nothing to do with whoever's in the White House at any given time. Is this whole issue of Fed independence really a thing, or why all the buzz, do you think?
Yeah, I think it started particularly with the president's interest in firing Lisa Cook.
Sure.
And basically, this was something that's never been discussed before, so hence
Right.
it had to go to the Supreme Court. And so I think just this buzz of saying, okay, and the Supreme Court basically said, no, you can't do that. But just the conversation of, oh, wait a second, a president firing somebody because they don't, maybe there's some political motivation behind it. I
I think
think
just for what it's worth, I think the accusation was that she had committed mortgage fraud by stating that properties that were not her primary residence were her primary residence in order to get a better interest rate. So I believe, and correct me if I'm wrong, but I believe that was the primary premise behind the desire to, per se, fire her from her position.
yeah, that's exactly right. This wasn't necessarily, I don't like you because you didn't vote for me kind of thing. I mean, it really was something that was, legitimate. Hey, this is not right. Was it a fireable offense, and can the president do that? And that's where, hey, maybe there's, another route of due process
Right.
where, okay, it's not driven by the executive branch, it's driven by the legislative branch that has oversight over the Fed and says, okay, we're going to take this and have kind of due process.
Yeah.
So that I think maybe just the publicity behind the executive branch attacking, a central bank, created this buzz. I do think there's always pressure from the executive branch on the central. So, for example, case in point, Greenspan, who just passed away, by the way,
Yep.
he talked a lot about, getting calls from several administrations. Right, he was a long-standing Fed chairman. He would get calls from all of the presidents, he served under, it, and pressured, hey, can you ease up on rates? Everybody wants that, right? Because you don't want anybody to take the punch bowl away. And that was Greenspan's, analogy, right?
Yeah.
You don't
Yeah.
want to take the punch bowl away at the party. Keep rates low, and that stimulates growth, and the economy looks good, and the president can say, hey, it's all my, it's because of all
Right.
my good policies. So
Policies. Yeah.
so there shouldn't be any surprise with the executive branch wanting a certain direction. Every president's going to want rates to go lower.
Sure. Yeah.
So that's not a surprise. The surprise is that he is kind of the, hey, let's do this. And then of course, it was, maybe it is for cause, but it has to have due process.
Right.
I
Yep.
do think, like I said, I love my country for many reasons, and it's kind of cool to see that even that representative structure is even embedded in our central banking. So,
Yep.
for example, you're a dairy farmer in Iowa. You're going to be represented through the Kansas City Fed. When the Kansas City Fed president ends up being a voting member, his views, because truly every FOMC meeting, they hear economic updates and reports from every one of those 12 districts. You live in, you got some dairy farms in Pennsylvania. Yep, you're represented. You got cornfields down south, soybeans down south. You're represented. That's wonderfully American, isn't it?
I think it's great. And I'm also fascinated by currency. And if you pull paper dollars or paper money out of your wallet, you will see to the right of the picture of whatever president is on there's a kind of a dark circle that's got a letter in it. And each of those represent one of the, per se, regional Federal Reserve banks around the country. So
That's right.
if you've got, Philadelphia or Kansas City or Richmond or so just neat in terms of understanding Federal Reserve and federal banknotes and dollars and all these different things. Just fascinating. So you'll excuse my enthusiasm, Jeff. I love this
That's great.
stuff, and I appreciate the time that you've taken to chat with us. Well, we are right at the top of the hour. Michelle, do we have any closing comments?
No, I think that's it.
Jeff, I'll ask you for your closing comments, and you can sign us off.
Yeah, well, just a reminder. I mean, we're here at the research team at LPL, and we support you, Ward, and several other fantastic advisors around the country. We're here to support, and we're here to cut through the noise. And the value, of course, is having a financial shrink, aka certified financial planner, to walk through these waters with the end client, and we try to stay behind the scenes, and we're here to help in any way. So reach out anytime.
A great presentation. Thank you for your time. Thank you for your friendship. We'll do it again soon. And we're
All right.
thankful that the technology held up the whole time. It's been rumble and thunder right outside the windows. It is very, very dark right outside our windows. And we are thankful that our technology held together for the whole program. So without further ado, have a great rest of your evening.
Take care.